In just the last 4 years, the price of eggs went from being $1.50 in June of 2020 to over $3.65 today, a 140% rise. Oil went from around $37 to over $75, a 100% increase. And home prices have gone from $320,000 to $420,000, so a 30% increase. This led to one of the largest inflation spikes in the United States since the 1970s that ended in massive wealth destruction. Since then, inflation has come down quite a bit, and it currently sits at 2.9%. But many are getting concerned by the fact that it seems to be staying stuck at these levels, and in the last few months, even beginning to show signs of turning back up. One indicator that suggests that inflation may actually be heading higher is this line, called the ISM Services Prices Paid Index. This reflects how much businesses are seeing their costs fluctuate, a factor that can directly influence inflation. When this line is high, it means the cost of doing business is rising rapidly. And when this line is low, it indicates business costs are declining. This index has proven to be a reliable leading indicator for overall inflation. If we add the US inflation rate on top and shift it behind by about 3 months, you can see that inflation is closely correlated to the ISM Services Prices Paid Index. And this makes sense because when businesses face higher costs, they often raise prices to maintain their profit margins, which ultimately contributes to higher inflation levels. For example, the ISM Services Prices Paid Index rose about 3 months before the inflation spike in 2021, and it also accurately anticipated the decline in inflation in 2022. Now, in 2025, this index is once again climbing, suggesting that inflation could turn back up in the next 3 months or so. But if we dig a little deeper, we see that one of the most significant drivers of ISM Services Prices Paid in the US economy is wages. Since the 2020 pandemic, wage growth has seen a significant rise, reaching the highest levels in 25 years at one point. Even now, wage growth remains pretty elevated compared to the past decade, which has been contributing to the sticky inflationary pressures we're experiencing. However, the broader trend shows that wage growth has been consistently declining since its peak in August of 2022, and there are signs that this trend is likely to continue. That can be seen by putting the chart of job openings on top of wage growth and shifting the chart of job openings forward by about 1 year. You can see that throughout history, job openings have been quite a strong predictor of future wage growth. The reason this relationship exists is when there are plenty of job openings in the economy, workers feel confident about finding a new job and are more likely to negotiate for higher wages. But when job openings decrease, workers tend to prioritize job security, putting less upward pressure on wages. Now, if we look at job openings in the US, we can see that they have been steadily declining since its peak in March of 2022, suggesting that wage growth is likely to continue trending lower. And if wage growth does in fact continue to move lower here, then it would put downward pressure on inflation.